Most beginners think that like investing is complicated or one strong thing to do just like that. They imagine they need dozens of stocks, complex strategies, hours of research, and plenty work to be able to invest. But the truth is that some of the most successful investors use surprisingly simple portfolios. In this video, I am going to show you how to build a simple investment portfolio, how to diversify properly, and how beginners can create portfolio designed for long-term growth. Let's get started. So the first section or segment we're going to be looking at is the investment portfolio. So an investment portfolio is simply the collection of assets that you own, like collection of different assets like stock, ETFs, bond, real estate investments, and cash equivalents. Think of your portfolio as your financial team. Each investment has a job to do. The goal is to create a team that works together to help you grow wealth while managing risk. Now we're going over to section 2. Section 2 is why diversification matters. One of the biggest mistakes investors make is putting too much money into one investment. Imagine putting all your money in a single company. If that company struggles or your portfolio suffers, diversification helps, or it means spreading your money across multiple investments, and it helps to check risk or manage risk. That's why it's good to diversify. This reduces the impact of any single investment performing poorly. Diversification won't eliminate the risk though, but it will help manage it. And section 3 is understanding risk tolerance. Before building a portfolio, ask yourself, how comfortable am I with market fluctuations? See, some investors can handle large ups and downs, but the others prefer a smooth ride. So your risk tolerance should influence your portfolio structure. There is no perfect portfolio for everyone. The best portfolio is for you to stick with the one that you're good at. Stick with it during the good times, stick with it during the bad times. At every point in time, the one that you want, just buy it and just keep doing investing in like surrounding it or other stocks. But just make sure that you don't stop. Whether it goes bad or it goes good, just continue. The fourth one is we are going to be looking at the different types. There is four section. We're going to be looking at the different types of portfolio. The first one is a conservative portfolio. The conservative portfolio prioritizes stability. For example, it gives you 40% diversified stocks ETFs, 40% bond funds, and 20% cash or cash equivalents. This approach may experience smaller market swings but often grows more slowly. Like it grows very, very slow because everything is at like lower rates. The things that are supposed to be making it grow faster, you bought them at lower percentage. The second type, sorry, the second type of portfolio is the balanced one. A balanced portfolio is one that balances or is between that wants sorry, a balanced portfolio is a portfolio for someone who wants both growth and stability. For example, 60% diversified stocks and ETFs, 30% bonds funds, and 10% cash. Now, why it is going to more of the stock and the ETF is because we want your investment to grow. You don't just want to be watching it go slowly or move down or upwards. You want it to grow. So you have to like share it equally. And the main place where you're supposed to share it equally is in the ETF because the ETF is a compilation of different companies coming together for just like you're combining different companies for you to come and invest in. Now, this is the common middle ground approach. Then the third portfolio type is the growth focused. Now, a growth investor focuses on primary long-term stocks or primarily focuses on long-term wealth building. Now, let me give you an example. You have 80% diversified stocks ETF, 15% individual stock, and 5% cash. Now, why it is 5% cash is because at every point in time, you can work for more money. But for stocks, you need cash to be able to buy stocks. So if you don't buy much stock and work for more money, and you're like saving the money will reduce in value, but the stock will continue increasing in value. So just it's better to store the money or to put your money more on stock and store little money. So whether inflation comes or not, you have hope. Now, this particular portfolio It may experience like larger fluctuation but offers greater growth potential. Now, section 7, why ETFs are popular. For many beginners, ETFs are one of the most easiest way to diversify. Instead of researching on dozens of stock or companies or industries, one ETF can provide you with an exposure of many businesses at once. Now, the benefit of diversifying or ETF is that, sorry, the benefits of ETF is that it enables diversification. Like diversification is allowed. It is simple to use. That is simplicity. It has lower research requirement because you're dealing with a lot of companies. Now it is beginner friendly because you don't need to research. You don't need to go into much details to be able to look for what you're looking for. You just invest in the ETF. It to spread the money across. So when one is underperforming, it's not going to affect the others because sorry, when one is being when one is being affected, it's not going to affect the others because you already know that this is what is going on and this is how it's going to, like, you already have like multiple companies that you've already put your money into. That's for the ETF. You have multiple companies that you've put your money into. So if that one is underperforming, the rest will be able to push it up and tell you, as they see it, no worry, come, we'll go carry it for, but the more they go, the location where they go. That's what ETFs will help you with. Now, section 8, that is rebalancing your portfolio. Over time, some investments will grow faster than the others. This can change your portfolio allocation. For example, an 80% stock allocation will become 90% after strong market rally. Rebalancing means adjusting your investments periodically to maintain your desired allocation. Many invest many investors review their portfolio once or twice a year. Now, yes, let me tell you why this is so. See, at some point in time, today, let me give you an example. Let's say you have two friends, one is Obi, one is Okon. Now the two of them, they are together. They've not like gotten experience, they've not gone far into the business, or they've not gone outside to go know what others are doing. So but Okon has more of the pressure of business. He wants to do business, he wants to do business. And now Okon goes out and Akpan goes out. Now let's say Akpan is one that does not have that interest. But Akpan now went out to go and stay with someone that likes investing. And Okon went to go and stay with somebody that does not know how to invest and does not even like investing. You find out that over time, Akpan is going to grow to like investment because of he is with an investor, while Okon will not like to do that. Now, that is what is simply playing here, what is going to play here, whereby the investors go and check their portfolio like once or twice in a year. Because if you don't check it, how will you now know that Okon that was gingering in the beginning that he must do investments now it's going to fall into the hand of someone that does not like investment? And you find out that as Okon has already fallen into the person that does not like investment, Okon is not going to grow in investment again. Thereby, he is now a fall, like if he's a stock, it's going to be a stock that is having a downturn. And Akban that is staying with someone that likes investment is going to have like good is going to do is going to have an upward turn on his stock and investment. That is how it works. It doesn't, like, you don't need rocket science to understand it. It just comes close and comes to you. Now the next place you're looking at is the common portfolio mistakes. So let's discuss the mistakes to avoid. The first one is owning too many investments. Too many talk, no the full basket. That is just the simple explanation of that. If you own too many different investments, you find out that all of them, you are spreading money, so they are not going to be much. So if the return is supposed to be much, it's going to be low. Second one is chasing trendy stock. See, let me tell you people something. I don't know how you people see, but this is me. See, you see trends. Once something start trending, check it very well. That thing has gone. That thing has left. That thing is not going to ever grow. It's not going to happen again. Just give it 3 to 6 months, it's gone. Let me give you an example. Yahooze. If you know Yahooze, type it, I know Yahooze in the comments while watching this video. Now, you find out that nobody knows who sang Yahooze. Nobody knows the song Yahooze again. It's only old, like people that were then when Yahooze was trending. And tell me the truth, did Yahooze trend more than 1 year? No. Nothing trends more than that period that the thing is trending. And immediately it's done, it's done. It's done and dusted. It is wasted. And the next one is ignoring diversification. Now let's say if let me tell you something. Everybody in this world has diversified from Stone Age to Iron Age, from Iron Age to all technology down to the era of technology. It is diversification because we started finding out that okay, we can wash plates with sponge and soap. Then we now say no, let's diversify and go into technology and buy dishwasher. So that's diversification. It's diversification that helps us to grow, to get more things. And that's also like another thing too is research. Do you get? You don't have to avoid research. Always research. The next one that we're looking at is constant buying and selling. It's better to constantly buy than for you to be buying and selling. Let me give you an example. You bought fuel now today for 1,350 and you sell it in the evening for 1,004. That you would have left to reach the next morning to reach 1,400. So that's how it is. The more you keep on buying and selling, you're not going to be growing. You'll be seeing small money. And if you keep it for a long time, you see that your investment will go and give you more base or more cash. Now, the next one is taking excessive risk. Now, taking excessive risk is the fact that you know that this stuff you're doing is not good, but you continue doing it. Or you start trading like a prostitute. Let me give you an example. Now, you know that instead of you to do research about a particular stock that is trendy, you just go and buy it without even knowing whether the stock is going to close down tomorrow or next. So when you now buy it and something now happens to the stock and the stock now takes a down to, you understand that you've already done like you've taken an excessive risk, or you've risked too much because you've invested too much money in a particular stock that you did not research on. That is stupid risk, excessive risk, stupid one. Instead of you to manage how to like curtail your losses, because risk has to do with loss. It's the amount you stake that is the amount that comes out or returns to you. So instead of you to like manage it, you now come and be looking at how you come and start leaving it, and you keep on doing one particular investment instead of spreading it. Do you get? That's what happens to you. The next one is having an investment plan. Now, having an investment plan is very bad because when the money that you want to use to invest comes in, you're not going to know what to do. You're not even going to use it to do the investment. Talk more of not knowing what to do. So that's how it is. Now, don't forget, simplicity beats complexity. And why I say simplicity beats complexity is because you don't need to go for like complex stocks that you have to research. Just go for the ones, simple ones. Like I told you, most of the stocks I buy, I don't go and buy big name or brands. What I buy is the products that are on the streets 24/7 because I know everybody's using it. So now that's leading us to the next section because this video is getting too long. Building your portfolio step by step. Now, step one is define your financial goals. Two is determine your risk tolerance. Three is choose a diversified foundation. Four is invest consistently. Five is rebalance periodically. Six, stay focused on long-term growth. So that's where so don't forget that the key is creating a plan and sticking with the plan. Now, so what does a successful investment portfolio look like? It does not have to be complicated. In fact, simple portfolios are often easier to manage and easier to stick with. Remember, diversify, understand your risk tolerance, invest consistently, rebalance occasionally, think long term. Building wealth is rarely about finding the perfect investment, but it is about consistency. It is about building a solid portfolio and allowing time to do the heavy lifting or the heavy work for you. So if you found this video helpful, please like, subscribe, and share so that you help someone else out in his investing and investment journey and life. Thanks for watching. I'll see you guys in the next video. Bye.